ULTA Beauty is a company that specializes in cosmetics and fragrance, and over the past year they are down by 13%. It is one of the companies that Warren Buffett was loading up on in the past quarters. And so in today's video I want to show you exactly why ULTA Beauty is undervalued and why buying it at its current trading price will yield you great return. And to do this we will of course use our stock valuation spreadsheet, where we'll have a look at the fundamental 9-pillar analysis and calculate the intrinsic value of ULTA using our 4 valuation models. Now it doesn't mean that if Warren Buffett or anyone else is buying or selling a company that you should do too. This video is here to show you exactly why ULTA Beauty is undervalued and to teach you the process of valuing a company. And with that, if you do enjoy these spreadsheets and if you find them helpful, you can always download them in the link in the description. Now we have already plugged in ULTA's ticker ULTA, and right away we can see that they are not a dividend company. They currently don't pay out any dividends whatsoever. One thing I do like about the company though is their very high institutional ownership, sitting at 91.44%. We can also see that the analysts have a target price of $425 within the next year, which is quite higher than the current trading price, sitting at $360.47. Now jumping straight to the 9-pillar analysis, we can see that the company gets a rating of 7 out of 8, as the 9th pillar is the consecutive dividend growth, and as we know ULTA doesn't pay out any dividends. So looking straight to the first pillar that is sitting in the red, the 5-year PE ratio to be below 22.5. We can see that the 5-year average for ULTA is sitting at 32.70, which would be considered overvalued compared to their earnings. But if we have a closer look at the 5-year PE ratio, we can see that indeed it has been sitting on average at 32.70, but the reason for that is the extremely high PE ratio in 2019, sitting at almost 90, which raised the average. In all the other years, we can see that the PE ratio was sitting in the range we like to see, below 22.5, and currently it's sitting at only 14.47, which hints that the company is undervalued compared to their earnings, as investors are only paying $14.47 for every dollar of a company's earnings, which is much lower than what investors pay for other companies' earnings. So we can say that the pillar is actually sitting in the green. Now let's have a look at the remaining pillars. We can see that their 5-year profit margin is sitting at 41.84%, which is much higher than the minimum value of 10% we'd like to see. We also know that they have been decreasing their shares outstanding at a rate of 3.31% yearly over the past 5 years, and we can actually have a closer look. In 2019 they had 58 million shares outstanding, and currently they only have 49 million shares outstanding, so they decreased their shares outstanding by almost 10 million in the past 5 years, which is phenomenal. Now back to the 9-pillar analysis, we can see that their price to free cash flow is sitting at 19.75 over the past 5 years. This is a very similar metric to the PE ratio, except for earnings we look at the free cash flow of the company. So investors are currently paying $90.75 for every dollar of the company's free cash flow, which is in the range we like to see. Now regarding the company's growth, we can see that they have been growing their revenue at a rate of 10.51% yearly. They have been increasing their free cash flow at 9.40% yearly, and they have been increasing their net income at 81.84% yearly. So let's have a closer look at these 3 metrics. So pillar 3, we can see that indeed they increased their revenue from 7.4 billion in 2019 to 11.2 billion in 2023. Now regarding the net income, they increased it from about 705 million in 2019 to 1.3 billion in 2023. So we can see that the high growth rate of 81% is because of the growth from 2020 to 2021. So overall the average net income growth rate is sitting at about 8% yearly over the past 5 years. So now we have covered almost all the pillars except the long-term liabilities over the 5-year free cash flow negative dividends to be sitting below 5. And as this ratio is sitting at 0.40, we know that ULTA generates enough free cash flow to cover all their long-term liabilities without an issue in the next few years. Now summarizing ULTA Beauty's 9 pillars, we know that they have great growth in all 3 sectors. They are currently trading very cheap compared to their earnings and compared to their free cash flow. They have decreasing shares outstanding, a very nice high profit margin, and they won't have trouble with paying off debt anytime soon. And something I also get from this very low ratio is that ULTA Beauty has a lot of free cash flow left over, so they might start paying out a dividend in the next few years. But now let's calculate ULTA Beauty's intrinsic value, first using the grams formula revised. And here, besides all the other values that are plugged into the spreadsheets automatically, we have to predict the 5-year earnings growth estimate, which we predict using the 9-pillar analysis and the research I did in the backend. So what I do is I plug in the high earnings per share growth estimate, the medium earnings per share growth estimate, and the low earnings per share growth estimate, which I average out with the analyst growth rate estimates, and get a 5-year earnings growth estimate of 7.47% over the next few years, which gives us an intrinsic value of $322.84, which is actually 12% lower than the current trading price of the company. But we still have 2 more models to go through, so jumping into the discounted cash flow model, where we plug in the free cash flow over the past 5 years and calculate an average growth rate of 9.40%. Now, to calculate the future growth rate of 7.7%, I used the same method as before. I predicted the high growth, the medium growth, and the low growth, and using that, I predicted the future free cash flow over the next few years. Now, the present value of that future free cash flow is calculated by the discount rate, and the discount rate is essentially the minimal rate of return you want from your investment. So again, using the same method, we plug in the highest year-over-year return, the medium, and the lowest, which I plugged in at 9, and get a discount rate at 8.8%, which is very similar to the WACC of the company, and calculate the present value of that future free cash flow, and this gives us an intrinsic value of $483.54, which is quite higher than the current trading price of the company, showing us that ULTA really has great free cash flow growth. And now moving to the final valuation model, the multiples valuation model, where we compare ULTA to its competitors. We take ULTA's 4 competitors, take their current stock prices, and divide by their current earnings per share to get their PE ratios, which we average out, and we can already see that the average PE is much higher than ULTA Beauty's price to earnings. And so when we multiply it with ULTA Beauty's earnings per share, we get an intrinsic value of $514.91, which shows us that ULTA Beauty is indeed undervalued by quite a lot compared to its competitors. Now we will skip the dividend discount model as ULTA doesn't pay out any dividends and arrive straight to the ultimate valuation, where we average out the 3 valuation models and get an intrinsic value of $440.43, which is 22.18% higher than the current trading price. And if we plug in a margin of safety of 10%, we get an acceptable buy price of $396.39. So yes, buying ULTA Beauty right now at its current trading price would certainly bring you great return. The company is currently quite a lot undervalued, and their 9 pillars are all sitting in the green as we saw. But of course, before adding this company to your portfolio, you still have to do some more research in the backend and figure out whether it even fits into your current portfolio. And with that, I hope you enjoyed the video. Let me know down in the comments which company you'd like me to evaluate next, and leave a like and subscribe as it really helps me out.